Welcome to hour two, where I'll go through some basic strategies. Now, we're not going to hit these at a real high level in this particular section. I saved that from the class that I offer. And I go into the background. We go through how we develop the different instruments that we use in these strategies. And yes, they're built around options. We use calls and puts, and we use them together and we use them separately. So having a good understanding of that is pretty imperative. But at the same time, there can be a bit of a learning curve with options. The idea that a call option gets more valuable as it goes up, that's really all you need to know. Now, there's other things that we study as far as options are concerned. There's a thing called the Greeks, and there's different strategies that you can implement. And there's the other side, which are puts, and they get more valuable as a price goes down. But for some reason, people have a real hard time with that, especially when you get to the point where you're buying and selling options at the same time. And I do go through a lot more detail, but the idea is when you buy an option, you have to have the money to buy it. Okay, so if it costs $500, you have to have $500 in your account to buy that option. Where it gets a little more tricky is when you sell options, because you receive money. When you buy an option, you're paying money out, and then that option will become worth more or worth less than what you paid for it, just pretty much like a stock. But when you're dealing with selling options, you receive the money from the start. And then from that point until you close the position, it's how much of that you received do you get to keep? And you not only have to have the ability to be able to do that in your options account, but you have to have the money behind it in case something goes wrong. So if you sell the right for somebody to buy a stock from you at a certain price, and that goes against you and for them, they're going to exercise that. And so you have to have the money behind it to actually buy what it is you say you'll buy, or sell what it is you'll say that you'll sell. What I do, we stay away from that. We don't do those kinds of strategies. We're always protected. Now, there are more risky and more aggressive types of strategies that you can implement, and you'll have to decide for yourself what kind of strategies you want to implement, because you can be very conservative with this, you can be very risky or aggressive with this, and then anywhere in between. I prefer the more conservative side of things, and that's just the path that I choose to take. And my whole approach is kind of different than most people out there. The idea behind options is you want to buy something for $500 and be able to sell it for $3,000 or something. I'm just looking at 20% profits, getting in at 500. Okay. And then when we get to 600, okay, that's a 20% profit. We get out of that position, and then we move in and let compounding take over. We get into the next position after that, where now we can go for $600, where before we started with 500. And that's where the true power comes from. Plus, you have the ability to take whatever size account you have and break it up into different chunks. And I call them tracks. And so you might have 4, 5, 6, maybe even 10 tracks going at the same time. And maybe one of those tracks totally falls apart. Well, the other ones, they're still doing okay. And the idea is that you're not throwing everything into each position that you're getting into, because then if things go right, yeah, that's really great. But if they go wrong, you can see some pretty sizable gains that you might have had before suddenly vanish. And that's not a very good feeling at all. So that's kind of the background. And I'll be going through some different examples and different strategies that you can implement. Okay. Let me go to the next one here, and I'm going to have to turn on my laser pointer. I seem to forget to do that. Okay, there are strategies that allow you to take advantage of what the market does, and because it can only do three things. It can go up, it can go down, or it can go sideways. And that's why we put so much, or I put so much emphasis on market evaluation I almost said market valuation, but that's a different thing, because I want to have a pretty confident idea. Is the market going to go up? Is it going to go down? Or are we going to go sideways? At the time we're doing this class, we're pretty much chopping sideways, and we have been for a week or so. But these types of environments typically don't last forever. We have some big economic reports coming out right about now when I'm recording, and that's probably going to shift the market one way or another. And so leading up to this period of time, we've been going more or less sideways. But that still gives you the opportunity to take advantage of things when it might seem slow. And there was a whole period of years that I went through, from about 2014 up until the 2016 election, right about in there. We had an upward bias, but we were not really trending with any real conviction. And that's when a lot of the sideways strategies really were more advantageous. And there are times when you want to implement those. Ever since, well, definitely since the COVID plunge, but in 2021, 2022, we've been more in a trending environment. And there'll be periods of time when we go trendless, but then we might have a bias in one direction or the other, where, okay, we're not trending right now, but things are pointing more positive. So we would do strategies that take advantage of that without necessarily setting up another kind of strategy that might run into danger. And then sometimes around holidays, like between Christmas and New Year's, so in the summer, we've been trendless a lot, just during different slow times. But then this can change, and then we can switch over to a trending environment, and then you are ready to go. You're armed with the different strategies that you can use during those times. So we can take advantage of the market when it goes up, and that's probably pretty easy to understand because that's what most people are geared for, and it's what most people do in the stock market. The idea of buying a stock at a low price, and then at some point in the future selling it for a higher price. And that makes sense to a lot of people. And we call that going long, and I'll go through that again. We can also take advantage of the market when we're going down. Now, a lot of people don't realize that, but over the years, I probably had most of my success, at least faster success, with the market going down, because we can take a long time to go up and up and up and up and just kind of chop higher, have a few down days and then some more up days. And that can take a long time. But when the market really turns negative, it tends to go pretty quick. And so if you get into a position and you're just about at the right time and we're going down, a lot of times those positions don't last as long because you've hit your targets pretty quickly. And then, believe it or not, we can even do things when the market goes sideways. And I worked out a spreadsheet at one time but this was before the COVID plunge. And this was from about 2013 to 2019 or so. And we spent about 60% of that time going sideways. And, we would trend either up or down during that time, but that's a lot of time that the market really isn't convicted one way or the other. We did have an upward bias because we were still coming out of the great financial crisis, and there was all this money that was going into the banks, and they were making their balance sheets look better, and they were putting a lot of that into the market. Interest rates were still really low during that time. And then about 2015 was when we finally started to raise rates again. And we went, 6, 7 years in there when interest rates were virtually at zero, kind of like they were right after the COVID plunge. And so folks don't mind using this money that they were given by the government, mainly businesses. And then after the COVID plunge, people would do that too. It's like there's no interest attached to it. You're basically borrowing money for free. Why not throw it into the market? But during that time, we were chopping an awful lot. And that's when I was really able to take advantage of this. Be aware, if you get emails or some kind of ad that you see that because The folks that teach about these things, they're generally late to the party. They discover something and then they start teaching everybody about it. And then that becomes all the craze. And about the time people are starting to learn this is when that particular strategy is no longer effective. And we've seen that in the stock market too. And people try to figure out what somebody else is doing and then they do the same thing, which is what I do, but I do it kind of in a stealthy way. They get you at just the wrong time. And by the time they send out their emails and get their ads up and going and get their classes full of people, you don't know if that strategy is going to work. And then somebody comes in, learns that, they lose some money or lose all their money. And they're like, well, this is rigged. This is screwed. I'm not going to do this anymore. This just doesn't make sense. What we need to do is be nimble enough to be able to change quickly. That's why I really rely on the day by day analysis of what's going on, because we can see things a lot quicker. As I said in the previous session, intraday is too fast because there's so much randomness that goes on in the market. And there's randomness that goes on daily too. That's why to predict what the market's going to do with any dogmatic certainty, you can't do that. You have to allow for the random nature of the market, because you think of all the variables that go in to the market every day, all of the participants, people buying, people selling, and for things to exactly repeat the same all the time, you would have to have all those variables be the same each time as well. And it doesn't work out that way with so many participants. And one day somebody's buying, the next day they're selling. One day volume is really high, the next day it's really low. One day we're going up, the other day we're going down, and people react differently. And a lot of times people make decisions in the stock market that don't have anything to do with what we're looking at. That's one reason why I say stay away from the open, because right when the market opens, you've got a lot of money. There's this pool. It's like you go to the horse races and it's like all the horses are behind the gate and they're just restraining them. And because a lot of people that make decisions, they have regular jobs and they can only evaluate things in the evening and on the weekends. And so they do that and they get on their computer, and the night before they log in to buy or sell something, and you get thousands, hundreds of thousands, if not millions of orders all backlogged. And all of those are to be executed right at the open for any particular day. And then that's why we often see a lot of gyration going around. And then about an hour to hour and a half to sometimes 2 hours after that, then the market settles down and then does what it's going to do for that particular day. And that's another reason that I'll bring up later on why I do things as close to the close as possible and I don't deviate from my plan. So just know that we can take advantage of any market situation, but there's still days when maybe we don't want to do anything. We're coming out right now with some big economic reports coming out. Maybe the Fed's going to meet and make an announcement, and we don't really know what's going to happen there. We might want to hold off for a little bit. Or maybe some event happens that really rocks the market. And you notice that during a lot of these events that we were in a pretty solid uptrend right before the COVID plunge. And that's one of the reasons we saw the big V-shaped bounce out of that. If you go back a few years, you look at Brexit, the market was in an uptrend. We dove after that when Brexit happened. And we resumed the trend that we had been in before. Going back even a little further, as I'm remembering things, when the Fed raised interest rates for the first time after the whole great financial crisis, the market freaked out for a couple of days, but then resumed the trend that it was going in before that all happened. And so most of the time, it might take a little bit, but it will resume what was already happening. And then we came up, and then as we were coming up out of the COVID plunge, that's when the announcement was made for interest rates being at zero, all this liquidity hitting the market, and the market just kept going and going and going and just set all-time highs. And 2021 turned out to be a very powerful year. Then we got into 2022 and the whole climate seemed to change. And it was a pretty choppy year. And if you're long the market only, you got hammered pretty good in 2022. And if you're short, you got hammered. Well, the idea is to be flexible enough and use different time frames so that you can take advantage of whatever is happening. We have long-term things that we do, which again, my definition of long-term is years to decades even. So you might hold on to this for a long time. And then intermediate term, that's usually the time frame that I end up focusing on the most. And you're more nimble in those areas, and that lasts from weeks to months. And you might be able to ride something while it's really going one way or the other. And then the short term is days to weeks. And when we're in a more choppy environment, we kind of have to switch over to the short term because these moves don't last as long. Okay, then a strong emphasis is placed on evaluating market conditions. Now, a lot of folks that teach the kind of strategies that I do, they don't even care. I've been to lots of different workshops and webinars where the guy is like, you just keep rolling them over until you finally get to a point where you're not losing, or at least you're breaking even. And you call that okay. Well, that's not good enough for what I want to do. And I'm a little more determined to spend the extra time evaluating what's happening. Plus, I just find it interesting anyway. And I feel that I make a lot better decisions. And that's what I want to help you to do as well, by really analyzing things. And then that's step number one. And then step number two is, okay, what strategy are we going to use at that point? But I really place a real emphasis on knowing what's going on based on what the charts are saying, not what the financial media is saying, not what the headlines are per se, not necessarily what's going on in Washington, D.C., but what are the charts telling us? Because it can be a real contradiction. You remember in yesterday's session where I talked about there's human logic and then there's stock market logic, and the two often don't have anything to do with each other. And just to reiterate the same example is like in a classroom as a teacher, if I have students that aren't doing what they should be doing, I can switch things around to manipulate them to make them do what they're supposed to be doing and things that they don't like to do. And the students that are doing the things that they like to do, I can reward them, maybe with something that they enjoy doing. So I can control the environment. Well, when it comes to the stock market and a lot of areas of our professional lives that we're able to control, we're not able to do that in the stock market. And so we have to be adaptive enough and versatile enough to see things as they're developing and to know when to take advantage of them instead of just sitting and riding it out, hoping and praying for the best to ultimately happen, where we can take it to another level and use logic behind that. And we end up coming out ahead, and we're a lot more informed, we're a lot more confident, there's less emotion that's involved in that whole process, and ultimately we can be much more profitable. So there's a specific money management approach, and I kind of mentioned this, where I set things up on tracks. But the idea is that we know what we're getting into before we even get into it. So we decide the market's going up, or it's going down, or it's going sideways. Then step two, what strategy are we going to use? Okay, now we find the strategy that we use during these times. What instruments are we going to use? Okay, here's the instruments. These are the ones that make our criteria. And this is what I go through in my classes. And then we take that and we put that all together as a plan, and we say, okay, this is how much I'm willing to lose. This is how much of a profit I want to get out of this. And I rarely ever leave the profit part with a question mark. There might be times when you adjust it, but I don't remember the first part of the saying, but the second part of the saying is pigs get slaughtered. Okay, like cows are fed and pigs get slaughtered. I don't know what it is, but when we want that last little bit of profit, when we're just trying to hang in there for a few more ticks on something, that's when we're going to end up, we're going from offense on to defense, and then at some point we're just running for our lives after that. And if you just stick to a systematic approach, it's a lot less stressful, and in the long run, and even in the short run, it's more successful. So what I do is I go with this 20% and out idea. So I get in, I'm looking at a 20% profit. A lot of times I'll also be willing to take a 20% loss. okay, and just say, I wasn't right on this one. The timing wasn't right. Everything in my plan, I executed it the right way, but things still didn't work out. Let's say we're going long in something and we decide the market's going up. We get in near the end of the close, which is another thing that I really stress. And then the next day something happens and we really gap lower, and all of a sudden we're down 20%. It's like, okay, that's the way it goes sometimes. Instead of, oh, please, please, please just come back to break even and then I'll get out. It's like, that's another thing about the stock market. We get just so relieved and so elated sometimes when we are showing a loss and we get back to break even and we're like, phew, well, you weren't even setting out to do that in the first place. You were putting money in harm's way to make a profit, not just to get back. You could have done nothing and got back what you put in. So there's these weird mind tricks that go on in the stock market that aren't as prevalent in other areas of life. But that's one of the things that I really stress. Now, you can take that and develop it into your own way of doing things, but I want you to understand where I'm coming from so that you can vary that, but so that I'm not necessarily going to adapt to what you decide to do. I can't, because if there's 100 people, everybody will be slightly different. But if I provide something that's consistent all the way through, then I think that'll be easier for you to take it and then develop it into your own thing. Okay, here's some basic strategies, and I have to keep an eye on the clock here, and I'm going to have to do this. Wouldn't you know that right before I got started in this, they were doing some construction, and it was right above where I'm at. And apparently everything in Belarus, it can only be fixed with a very loud drill. And it's right above my head. And so I had to shift to a different place to do this. And now I'm not hearing it. But of course, if I had stayed in the other location, it would be making a lot of noise. That's kind of like the stock market, you know? All right. So strategies that we implement are based on what to do. So what do we want to do? First, you have to understand what it is we want to do and know what opportunities are available to us. And then from there, we can say, okay, this is what to do. And then how to do it. How do you set some of these things up? And I don't go through it in real depth here, but I do in the courses, and then through the different live sessions and online discussions that we have. We go through these things and I give examples and we just do it. So it becomes part of a routine. That's the idea behind it. And then when to start it. So again, I have my own ways of deciding when I'm going to get in and ultimately when I'm going to get out. And that's the next point. And we want to define these things before we even get in. We want to know all about this. And we want to understand what we like, the idea of the profit potential, but what are the risks involved? What are we looking for if something that we're in is breaking down? And that's when we just want to be aware of these things, because as I said yesterday, the thing that really got me for so long was getting caught off guard, something I didn't anticipate. Well, if we try to cover as much of it as we can, now we're not caught off guard anymore. And we can, you hit a new level at that point, and it's a maturity level, and it's based more on wisdom. And then while I'm thinking about it, there's also this idea, I've worked with a couple of people over the years where you can always talk yourself into something and you can always talk yourself out of something. And a couple of people that I worked with, they never did anything. It's never going to be black and white completely. It's always going to be one shade of gray or the other. That's why in the videos, I point out the positive and the negative. I point out what's going up, what's going down, what's really not telling us anything. And that can change at any time. Suddenly a chart that we follow that really hasn't been all that helpful, suddenly it's screaming at us. And that's why I use the approach that I do in technical analysis, keeping an eye on all the different areas, realizing that it's still going to end up gray at the end. But we just have to try to make as much sense out of that as we can. but we try to plan out every aspect of our position. And I start off by calling them positions. I don't think I mentioned this yesterday, but I've mentioned this before. There's trading and there's investing. And I pretty much stick with the IRS definition. If it's something that's held for less than a year, it's a trade, and that's handled one way. And if it's something that's held for longer than a year, that's an investment. Now they're screwing with these laws all the time, so that could change, but that's kind of the blanket area that I go through. And we want to know everything that we can before we even open that position. Maybe there's a time constraint. If you're working with options, they only last for so long and they're going to expire at some point. And so you can't just, set it and forget it, like the guy on the rotisserie infomercials used to say. You have to keep an eye on these things. And if you're not able to do that, that's why most people, they're probably best off dollar cost averaging. They're just putting in some money month after month after month. If you have the time, as far as horizon, to do that, because it doesn't take much time to do it. You can get it automatically withdrawn out of an account. But to go the extra step and to do even better, it's going to require the dedication and the time. Watching the videos when you don't feel like it. When it seems like, if you're watching my videos, I'm saying the same thing day after day. You think I'm excited about that? No, I want things to be changing all the time, but I can only go with what I actually see happening. So we plan out everything, realizing that there are still things we can't control. We just take advantage of those things that we can control before we even open the position. So we know our profit target. Now, this can be adjusted sometimes, and that'll be up to you. I have it pretty much set. If you're never going to go broke taking 20% profits. And then you can couple that with compounding, and it can really produce some pretty sizable returns. And then what kind of a loss are you willing to accept? Typically, some people say, okay, 20% up or 20% down. Some people might say, I want a 30% profit or a 50% profit and a 10% loss. That's all everybody's a little bit different with how they want to do that. You have to allow for some slippage in the market, especially if you've been doing this buy the dip mentality. I don't believe in that. It's like, if you want to get in something at a lower price, hoping to sell it at a higher price, why in the world are you going to buy it when it's going down? I understand the logic, because it's like being on sale. Well, if you buy something that had been at 10 and you get in at 9, there's nothing to say it can't go to 8, 7, 6, 5, 4, 3, 2, 1. It looked great at 8. Well, maybe it looks even better at 7. So anyway, all right. And this is where I differ from some folks. And you hear there's a lot of very successful money managers that say, buy the dips, buy the dips. Well, what's the definition of a dip? It may be one thing to one person and something to another person, and there's no real definition there. Okay, and then different time factors that you might have to deal with. If you're very long-term, you're not as concerned with that. But if you're dealing in instruments like options and that only have a set lifespan, then you have to be concerned with that. And then using options, both calls and puts. And for the sake of this, calls get more valuable as the market, or as whatever you want, goes up, and puts become more valuable as whatever you're in goes down. That's really all you have to know for right now. It can go way beyond that, and we will go beyond that, but for just understanding the idea that we can play the upside and the downside using calls and puts are based around the strategies that I teach. Okay, there's really two types of strategies. The first one is directional. When we think the market's going to either go up or it's going to go down. And then there's market neutral strategies. And I've kind of alluded to those already. The market's usually doing one of those things at the same time. Let's see, I heard a noise. What's going on here? Let's see what's happening. Nope. Nothing that I heard is too strange. Okay, somebody commented to me on Facebook. That's what happened. Okay, where is the slide? All right, here we go. But just for some folks, this is a revelation in and of itself. The idea that, okay, I thought you could only make money when the market goes up. And I thought you could only sell something, how can you sell something that you don't own? That's probably the biggest question I get. Well, a lot of times to really make people angry, sometimes I answer a question with a question. I hate that when people do that to me. I ask a question and then they immediately respond with a question. And it's like, I asked you the question, answer it, please. But if you can sell something that you don't own, first of all, you have to use a different mindset to even understand the concept. But people buy things that they don't have money for. You buy things that you can't afford. We call that credit. So if you can buy something that you don't have the money for, just take it the next step. Do you think you can actually sell something that you don't already own? But then we take it beyond that and say these are two separate sides of a transaction. You're buying to get in, you're selling to get out. Okay, that's long. When you sell first, that's the first part of the transaction. And then we buy to get out. And people are like, oh, wait a minute. I'll say you threw me. I don't understand that anymore. Well, in my class, I go through lots of examples, even in the basic class that I have here on YouTube. You can go in and check that out. And I go through because I'm not exaggerating. I've had 8-9 hour conversations with people trying to explain short selling, and they still don't really get it. It's just one of those things. So I use a lot of different examples, and I understand that it kind of takes a click for that to really come home. Okay, so directional strategies that I mainly focus on, and there's more than this, and you can get just as crazy with this as you want to. I like to keep it fairly simple. Because I put so much emphasis on market direction and where we're headed, that's pretty much served me well, and so I want to see if it'll also serve you well. So we have bullish strategies. This is when we think something's going to go up, and we're long at that point. We say, okay, I'm long. If you mention that to me or somebody else, I know that you're hoping something's going to go up. And then we have bearish strategies, which is when the market goes down, and we tend to call that short. Now, I don't divulge the actual strategies that I do. I want people to think for themselves and to develop their own strategies. But I might come to you, and just say, okay, I'm net long right now, which means most of the strategies that I'm implementing are going to benefit if we go up, or I'm net short right now. And that, because I'm trying to really hard not to be some kind of a guru that people follow. And then some of the guidelines. Now, this is a big deal with me, and it goes against some logic out there, and it goes against what some people teach. I say a directional strategy is only implemented if the market is looking to close, not open, close in the desired direction of the opening position. Now, that's a long way of saying if we're looking at getting into a long position, you only get into it as close to the close as possible, and only if the market is up. If you're looking to get into a short position, we do it as close to the close as possible, because that's the professionals are the ones that close the market, and only if the market is down. And that has saved me, I don't know how many times. Yeah, there's some times when you'll still have losses, and you do things that way. You finish one day, and then there's a big gap, and you hit your loss target, and you're gone. You can't avoid that. That's just part of what happens. But the idea that, okay, we're going to go long and then we have a big down day, we're not doing anything at that point. Or if we're going to go short and we have a big up day, we're not doing anything. Some of the biggest up moves you'll see in a bear market. Some of the biggest down moves, a la the 2020 crash, you'll see during a bull market. And the market has a real tendency to move in the opposite direction quickly within the confines of a longer term trend. But that's kind of, and that's why with the program, I might go live the last 30 minutes to 15 minutes when we're looking to go long or short or initiate a directional position, because we might want to all get together and, okay, it looks like we're going to close up today. And I know we can't do anything about these last minute sell programs that kick the market down right at the end. there's also a thing called the market on close orders, which a lot of day traders use, that they're out when the market closes, and that can often go against what the market had been doing that day and give you some skewed results by the time we close. So we can't do anything about that. We can only control what we can control. And then a directional position is never opened at the beginning of the day. Now, we might use it to close a position. I've done this many times when I'm long and I'm getting close to my profit target, and we're looking to gap up and I'm looking to get out. And so I go ahead and close it either at the open or pretty much right after the market does open. And instead of getting a 20% profit, I might get a 30, 40, 50% profit. I've had that happen a lot of times. So we can take advantage of the close of getting out of a position at the open of the day, but most of the focus is really stressed on getting in near the close. Because if you enter the position the right way, most of the time, the rest of this whole thing will take care of itself. And then positions are opened as close to the close as possible. The old adage that you'll hear me say over and over. It's the amateurs who open the market. It's the professionals who close the market. And we want to be more like the professionals. And there's a lot of temptation. You know, you get on your platform, you're looking at things, and it's like, okay, I watched the video, but man, we're really going down right now. And John pretty much concluded that we should be going up. But look at this option right here. Maybe I could get in right away and do that. That's on you at that point. If you want to do anything like that, you're welcome to do it. It's, you know, you're free to do those things. But I'm not necessarily going to be presenting those kinds of strategies to do. And then if a position is losing, we never add additional funds. I've done it myself. I've had lots of people that are friends. I've had students that do this, that you buy something at 10 and it goes against you and it drops down to 9. So then you buy a little bit more. Well, now your average price is 9.5. And then it goes down to 8. Okay, now your average price is 9. I don't do that. You're throwing money after a losing trade at that point. And yeah, your average price might be lower, but more often than not, it's going to end up being a losing position, or you're going to get back to the point where you get back up to your average and you get out, and now you ended about where you started, and that's no fun. So we only add to positions when they're going in our favor. And I think that's, yeah. If we want something to go up, and it does, and we're saying, okay, I want to add to this position. Is it still going up? Yes. Okay, then I'll increase my position. Now, another thing that I often do is I'm still doing that 20% and out thing. So that you might have one position that you get in, it makes it 20%, you're done. That money's now out of the market and safe and can be used again in another position. But now you have another position going based on that same call, that same strategy. I shouldn't say call because that's an option, on that same outlook on the market. And you can just kind of ladder yourself up if we're going up, or ladder yourself down as we're going down, and be just banking profits all the way up and all the way down. Now, some of you're going to want to build it more like a pyramid, where you might put most of your funds into it right off the bat. And then if it's going in the right direction, you'll just kind of add to it that way. And then we'll hit some point, whether it's going to be a profit target or a technical analysis target. We hit a moving average, we hit resistance, something like that. And that triggers you out, and then you just close out everything at that point. That's some of the things that you're going to have to come to terms with for how you want to manage these things. And different people are going to do it different ways. And that's where your own individual personality comes in. But we never add to a losing position, because then if it completely falls apart, we're not throwing good money after bad. And now we're suddenly fighting for our lives instead of saying, okay, that one just didn't work out. You know, it's like baseball. It's the only thing I know in life where you can fail 7 out of 10 times and be paid millions of dollars a year to do it. I mean, would you go to a doctor that was only right 30% of the time? Would you fly in an airplane that only had a 30% chance of actually arriving at its destination? No. But there's still always that probability that something's going to go wrong. And although we don't want to have a lot of serious losses in the market, of course, we can't do that. We want to limit them. And this is one of the way to just say, okay, that one didn't work out. You're not going to win them all, kind of a thing. And I know it's easy to say in the context of what I'm saying right now. It's a lot more different when you're on the line, especially when you've been on a roll. And that's when you have to be the most careful. You play a sport, you get in the zone, or as a musician, you're in the groove and everything's just clicking and going right, and everything's just coming together. The market's different than that. There are times when we go through a good phase in the market and you might have a lot of successive wins. That's when you have to be the most careful, because then you start to take the market for granted. And in the workshop that I have, I talk about being presumptuous, where you just think, well, I got this down and we're just going to ride this wave. That's usually when you're going to get wiped out, or at the best suffer some kind of a major loss. And that's why one of the courses that I also offer has to do with mental analysis, because we have to be on guard when it comes to the market. Okay, some bullish strategies. And I want to keep an eye on the time here to make sure that I'm not going over too much. So one of the strategies that we could implement that are bullish, and for the bear strategies, it's going to be kind of a mirror image of this. So don't worry about it if it's like I'm going to go through these and then it's going to be kind of the opposite when we get to the bear strategies. And there's some that we don't implement. So this is to profit when we're going up. The first thing you can do is just go long. Now, I'm just assuming we're not at this level now, but I'm saying, okay, the SPY is at 450. And then you multiply that by 100 if you buy 100 shares, and your cost is going to be $45,000 for 100 shares. And that's what a lot of you are going to do. And that's cool. And you can make money doing that. And then I have the possible maximum profit. That's not PIMP. Okay. I tried to come up with a better acronym, but this is as close as I came. Where if you get in at 450, theoretically, you could hold on to that for a long, long time, and you don't know what your profit could be. It's virtually unlimited at that point. You can get into an S&P 500 mutual fund that's based on the S&P itself. And even though mutual funds have been around a while, I forget, 1930s, something like that. The index fund was developed by John Bogle back in the 70s, and everybody thought it was a joke. Well, then it really took off, because most money managers and mutual fund managers, they don't outperform the market. So why not just be in the market? And the market is the S&P 500. So just invest in that. And that's more of a passive approach. And for most people, that's a really good strategy. But you get into a mutual fund that's just based on that. And then you can get into ETFs. Now, after ETFs, and right as I was getting involved in the mid to late 90s, I think it was 1996 when they came out with the SPY. That was the first ETF. And they're like, we're not sure if this is really going to work. Because 25 years ago, when I was implementing this strategy, I could only do it through mutual funds. Now you can jump over and we can use ETFs. We can use options. There's a lot more opportunities available to us that weren't available before. And we have weekly options now, where we just had monthly options to start with. And this is another thing that works to our benefit, is the more the merrier. The higher the volume, the better it is, because that produces liquidity, the ability to get in and get out quickly. Okay, but then we not only have like the SPY ETF, and I forgot to turn the light on again. Okay, hold on a minute while I turn on the light. I seem to start this when it's light outside, and then it starts to get dark and I have to run over and turn on the light. Okay, sorry about that, folks. Okay, so we have these ETFs. Well, people, they'll bet on anything that moves. That's why we can now invest in the VIX, because it moves. But we have these ETFs that are 1-to-1. So they're designed that way. So if the S&P goes up 1%, the ETF goes up 1%. Now they have juiced ETFs or enhanced, if you want to call it that. And there are mutual funds that are available that do this too, where if the S&P goes up 1%, an ETF may go up 2%, or they even have them where they go up 3%. Now that's really enticing. And if you're dealing with the greed factor, that could be, okay, that's the kind of thing I want to do. Be careful, because it's a two-edged sword. And because if the S&P goes down 1%, your juiced ETF is going to go down 3%. And that's a pretty significant loss at that point. And I tend to err more on the idea that, yeah, I like to be right, but we have to plan for what if we're wrong, and then take more of a conservative approach. And there's virtually unlimited potential when you're buying low and selling high, because there's no limit to where it can go. You can buy a call option. And at the time I prepared this, a call option that's 30 to 45 days out into the future, that's around the 450 level for the S&P, would cost you about $900. Okay, so to actually own 100 shares, that would be 45 grand. To control 100 shares for a certain period of time, that would be $900. Okay, do the math there. And would you rather risk 45 grand or 900? And a lot of people are like, well, yeah, I'd rather do the 900 and then keep the rest of my money in a different place that's safe. You can also enter what are called bull call debit spreads. That's where you're buying a call at one point, usually at the money. Okay, so the S&P is at 450. We would buy a 450 call 30 to 45 days out. And then we would sell a call above that. Maybe I think in the example that I did, I'd do it at 450. So that's 5 points. And the good thing about that is it costs less. Where if you just go buy a call option, that's $900. If you buy a bull call spread, that's going to run you about $600. But it also limits your upside potential, because you can only make the 5 points between the call that you bought and the call that you sold. That's it. And then you take out the money that you used to get into the position, and that cuts your profit down even a little bit more. So the maximum profit you could see on a trade like this would be $4,400. Now, some people are okay with that. Other people are not. You might want to spread it out, make it a 10-point spread between the two. Those are some of the things that you'll need to decide what you want to do. And then you can sell credit spreads. That's when you're selling something to begin, and then you're getting all your money at the beginning, and now you're just riding it out until you hit your 20% profit. Well, here it would be $40, okay? Or if you want to hang on to it for longer, because you're selling something to somebody else that you hope is becoming worth less every day, because that's how options are designed. The closer you get to them expiring, the less value they're going to have. And so you're selling them now with the idea that you can either let them expire and you get to keep the whole $200, or you buy them back at maybe $100 in the future, and now you've made $100 on that particular trade. So there's different ways that you can approach that as well, but you're limited in your profit right off the bat. The money that you take in, that's it. That's all you can do at that point. And now it's sit and wait time to see how much of that you get to keep. And you can also do calendar spreads, where you're maybe buying an option and then selling further out options, or you're buying a further out option and you're selling closer month options, very similar to a covered call, where you buy a stock and then sell options against that. And I don't do that one as much. The ones that I focus on, when I'm really confident about the market, I'll buy calls. When I'm not as confident, I might do bull call spreads. And then when I'm a little bit more confident, I'll get back into the selling credit spreads. And you can implement all of these at the same time and on different time frames, and just run these through your tracks that you set up. And then you can implement a covered call, which you may do later. If you buy a stock at 10 and then you sell an option at 12, okay, you're going to receive money for selling that option. But if the stock goes above 12, that stock's going to go away from you. Now, that's fine if what you want to make is what you get from selling the option. But if it's a stock that you want to hang on to, you might want to wait until it's actually gained a little bit first. Maybe you're buying the SPY at 450. You might wait until if we get to 460. And then you might sell an option maybe at 465 or 470 at that point, because you want to hang on to the SPY. You want to bring in the money from selling the call, but you also want to keep the investment that you have. And then implementing what's called a married put. And this, I did a supplemental video a few months ago. It's on hedging, or how you can protect yourself. And if I could teach one thing to people, it would be this. Because this would, people think that you get into an investment and that's all you can do. No, there's insurance, there's protection that you can set up to replace what you're losing if things go against you. The first rule is to try to guard the money that we're putting into the market. And then once we make some profits, now we want to lock in those profits the best we can. And we do that using put options. And it's not complicated. There's no conspiracy to say that they're keeping this from you. It's in every investment book that you'll probably read. It's just most people don't do it. And the real catalyst for doing the supplemental video had to do with ARK. It's an investment I don't own. I follow it, and it's very popular to a lot of people, and I go through it every week in the intermarket analysis video. But somebody got in right near the top, and they put their life savings into it, and that was it, 160, I want to say, and then it came all the way down to 30, and it was in a Facebook group, and this person was, I'm so mad at Cathie Wood. Anger, hate doesn't even begin to describe what I'm talking about. And I'm not making fun of the man. My heart breaks for him. He spent his whole life building up that nest egg, and it's gone, and if he had just been able to take that next step, it would have gone into his returns a bit. But that's what insurance does. Think about how much money you spend each month for life insurance, house insurance, car insurance, all the different kinds of insurance that we have to have. They're just the fact of life. Well, we should transfer that over to the stock market and make that a fact of life too, that there are things that you can do to protect yourself in the market. That's why the VIX moves, because when we look at the equity put call ratio, when the market's really going down, people are buying puts. They're hedging at that point. And the VIX moves all around because that's based on at the money options. When it's going up, that means that more hedging is going on. When it's going down, that means there's less hedging because folks have more confidence that the market's going to go up, and that's biting into their returns, and they're trying to get every penny of profit that they can, and so they're less likely to actually hedge those positions. And that's why we get the movement of the VIX. Okay. All right. And this is just a diagram, and I don't like these diagrams. They click with some people, but they don't necessarily click with me. When you're long a call, and let's say it costs you $200 for that call, that's the maximum that you can lose. You can't lose any more than that unless you add commissions to it. But then the upside potential as the stock or whatever instrument you're in is going up, it's virtually unlimited, but there's also a time life to this option as well. Okay, and then when we're doing the bull spread using call options, try to go back to the first illustration where you buy more or less an at the money option, and then you sell another option above that. And that's really what this chart is telling you. You're limiting your risk by it costing less. That's also, if everything just totally blows apart, that's all you can lose. But you're also limiting your upside potential. So it's risk versus reward. And then using protection, most people are just geared to make money if the market goes up. And long term, that's what the market does. But we have these intense downturns that sometimes we're really good at finding the exact wrong time to get in. because we're the center of the universe, like I talked about yesterday. In real life, this outcome is not always experienced. You're not always, there's no guarantee that things are going to go up. So put options can be used to act as insurance with the goal of protecting either the money that you're putting into the market or protecting profits that you've already experienced. So when you first get into either an ETF like the SPY or even mutual funds, you can set up hedging that way too. They're separate from each other, but you can equate the number of put options that equal what you own in an S&P 500 mutual fund. And even though one might be going down, the other one's going up, and they help to cancel each other out. So you purchase a put option at the same time. And I do that right away. The minute I get confirmation, I'm immediately getting that put option for protection. Then if prices go down, what you'll gain let me back that up. What you'll lose in your investment, you'll gain in the put option. And it's used to offset that. Now there's extra costs and there's commissions. It's not going to be, complete coverage. It's like insurance. If you don't want any deductible, you're going to have to pay more. If you're willing to suffer a little bit of a loss, like a deductible in your insurance, then you might buy some put options that aren't quite as expensive. So the goal is just to replace what was lost, whether that's your initial capital or capital gains that you've already had. Put options can also be used to lock in profits. And I go through this, and we deal with this in the daily discussions that we have. All right, and this is what it looks like if you're into that. You might want to freeze this. I'm just going to go quickly beyond this. Then bearish strategies are just pretty much the opposite, but we're just looking at the market going down. So we're going short at this point. We could sell short the SPY, but that's quite dangerous because you have to have the money behind it in case things can go down. Plus you're limited because something can only go to zero. And that's why we say that it's limited. Now, it's not very likely that the S&P is going to go to zero, but you never know. And you can get into an inverse mutual fund. There are mutual funds out there that go up in value when the S&P goes down. And you can buy inverse ETFs, either juiced or 1-to-1, where if the S&P goes down 1%, you have an ETF that can go up 1, 2, or 3%. But it's limited because you can only go down to zero. That's why I put this in here. And I'm keeping an eye on the time. I want to get through this in the hour that I've allotted here. Okay. And then you can buy a put option where it's not quite as expensive as the call option, but it can only go down to zero. But over the years, I've done quite well doing with put options. And then the opposite of using calls is we can do a bear put debit spread, which might cost us $300 to set it up. Our profit is limited at $4,700, but the most we can lose is that $300. And then you can sell credit spreads above current prices. And I have a chart to show you how I do that. And then I don't do this on the short side where you're implementing calendar spreads, because the longer you look out, the more tendency the market does have, it's likely to go up. And so I don't really do the calendar spreads, and I don't do the covered calls on the downside. I generally only do those up when we're going up. Okay, and then implementing a married put, well, we would do a married call in this case, and I generally don't do that. I'd stick with the strategies that are not in italics here. And then non-directional strategies, and I'm running out of time, but you could sell covered calls that I've already explained, and that's a way of generating some income. And in the late 90s, I did this for a living. That's what I was doing. I would buy a stock and then sell covered calls, and that was income that I was using. You can sell credit spreads at the same time. That's another strategy. You have to be more careful with those, but you're getting your money up front and then wondering, okay, how much of that do I get to keep? And then you can buy a thing called butterflies. I'm not a huge fan of these because you have to pick out a target point for the market to actually be in. They're not very expensive to set up, but I haven't had real good luck with those over the years, at least to this point. And then you can do a thing called iron condors, which is where you're selling above the current price and you're also selling below the current price. with the anticipation that we won't hit either of those. And sometimes those work really well. Other times they can be kind of dangerous when we're really moving. So the market may be going sideways, but we're looking to break out in an unknown direction. You can set up a straddle, which is where you buy a call and a put at the same time because you don't know. And I explained before that I actually made money on both sides of this one time. We shot up and we were really going to gap higher. So my call was doing really well at that point. So I got rid of it. The put at that point was almost worthless. It still had a few weeks until it was going to expire. And so I thought, just hang on to it. I'll get rid of the call, lock in that profit, just hang on to the put. Well, after we gapped up, we just started a horrendous downtrend. And within a couple of days, I made profits on that side too. Now, is that going to happen every time? No, but there are opportunities for that to actually happen. And then a strangle is like a straddle, where straddles you buy at the same price, where strangles you might vary them a little bit. And those are usually a little bit cheaper because strangles can be quite expensive. You're buying a put and buying a call. That's total outlay. You're not getting anything back. Where with the strangles, you're buying them a little bit out of the money, both above and below. So that can be a little bit cheaper for you. Okay. And then this all comes down to the daily plan, where you might be implementing 3 or 4 of these different strategies all at the same time. But then we develop that plan for the next day. Once we set that plan, we don't deviate from that plan. And then at the end of that day, we come up with, okay, and it might be the same plan, but we might have to modify it a little bit. And then as a side note, I don't share what I actually do personally. I may tell you that I'm net long or net short. Okay. If a new position is to be opened, everything is planned out ahead of time. This is the desired profit. And I hit this over and over again. It may be real simple and it may even be common sense, but when you get in the heat of battle and you've got thousands of dollars on the line, it's really easy for these things to fly out the window. And what's your loss? What are you willing to take? How long do you have in this position? And then we review this plan every day. We might make some adjustments. We might say, oh, this just isn't really working out. We might want to modify it. That's more on a case-by-case basis, but we don't deviate from the overall plan. And then we have a sheet that members have where you can fill this out every day. You can do it through a PDF and do it electronically. You can print these out and actually write them out if you want to do it that way. And every day, this is your plan for this day. And then some days that none of that plan will be executed. If we're looking for the market to go up and it's going down, there's nothing to do that day. Then we just come back, and then the day after that, we come up with a new plan and see if we are willing to execute that.